There are investors that make millions of dollars a month in passive income from this strategy that I'm going to talk about in this video. So I'm going to show you how these investors make so much money and the exact strategies that they use that you could replicate when you're buying your first or your next investment property. And towards the end of this video, I'm going to reveal one mistake that kills investor deals. I'm going to talk about DSCR loans, which is what investors use to be able to scale their portfolio to multi-million-dollar deals. First, let's get into what are DSCR loans and why they matter. So DSCR stands for debt service coverage ratio. And all it is that the income from the subject property that you are either buying or refinancing, that rental income has to cover your new mortgage payment, okay? So I'm gonna share my screen and talk a little bit more about how that works and do a full guide. I'm gonna cover mistakes that investors make that kills deals, and then also some things that I don't like about DSCR, so that way you get the full synopsis. So DSCR loans use the income produced from the subject property to qualify. Now, how it works is they don't require typical documentation like W-2 forms and tax returns or, anything that a traditional mortgage would need. And so it's really good for a beginner investor or experienced. This is perfect for you. And also, if you have like 10 businesses or you just have a lot of income documentation, it's just a very complicated mess of a situation, then that's where these loans really come into play and they help. Now, keep in mind that these are for investment properties only. So they cannot be used for primary residences. DSCR loans focus on the property cash flow because you're gonna rent it out. That's what they're for. So to qualify, it has to cash flow or has to cover the mortgage payment. And then the point number 3 is they require lighter documentation. These loans are really easy to get started. And honestly, people are surprised at how much of a breeze it is. All you need is application, a credit report, your driver's license, some lender forms that you fill out, typically saying yes, I intend to rent this out and I'm gonna use if I'm taking a cash out, I'm gonna use it for business purposes. Your most recent bank statement, and then your mortgage statement or homeowner's insurance if you're refinancing, okay? Now, DSCR loan structures are a little bit different from mortgages, but not quite different. So they all have prepayment penalties, and they come with, usually the structure is 5-4-3-2-1, 4-3-2-1, or 3-2-1. All that means is depending on how soon you pay off the loan, there's gonna be a certain percentage of the loan amount that you have to pay in prepayment penalties, okay? So if you do a 5-year prepayment penalty or a 3-year or a 1-year or a 2, you have that option as an investor. The catch or the caveat is that you have to buy it out in the beginning. So the higher your rate, basically, the lower your prepayment penalty. The higher your prepayment penalty or the longer it is, then the lower your rate. And I'll give you some examples. So what I mean by that is let's say we're buying a 3-unit building and we're putting 20% down because that's the standard for these loans. And I'm comparing a 5-year, 3-year, and a no-year prepayment penalty. So no prepayment penalties at all. Notice the difference. You're going from a 7.625 rate for a 30-year fixed mortgage, 7.625 all the way to 8%, just because of the no prepayment penalty. And these ranges vary, markets vary. So sometimes how the rates are gonna look is really gonna be up based on your state, how much you're putting down, your credit score, things like that. So looking at this loan here, we have the principal and interest and the taxes and insurance ranging from $6,098 all the way to $6,285. And so you can play around with the numbers, see what you're most comfortable with. If you know you're gonna pay it off soon, I would recommend buying out the prepayment penalty. Of course, if it makes sense. Every situation is different, but as an investor, you have that option. Really what the benefits are is that it's good for anyone. So whether you're a beginner or whether you're very experienced, these loans are good to get your foot in the door, or they're good for scaling your existing portfolio, okay? Now, keep in mind that if you are a first-time investor, there are some rules to this. Sometimes, some lenders require you to own a home for 12 months before you even can get a DSCR loan. Other lenders actually allow you to, even if you've never bought property before, to potentially invest for the first time, but most of the time they will require you to at least own some real estate. Now, they're really good for BRRRR strategies. So when you do a buy, rehab, rent, refinance, repeat, if you do a fix and flip, let's say you don't want to flip it and sell it, you want to hold on to it, that's where DSCR loans come into play because they don't need your income. They don't look at your debt. All they care about is the house or the 3-unit or the 4-unit building, right? So they're really good for exit strategies if you don't want to sell. and you want to just buy and hold. Now, for property types, they're good for 1 to 4 units, and they're good for 5 to 24 unit properties. Now, residential in our world is considered 1 to 4. Anything commercial is 5 plus units. And when I say commercial, I mean like in this context, 5 plus units, but every single unit is a tenant. It's not mixed use. However, there are loan programs for mixed use as well. If you have any questions, you can comment below on that. So for investors, like I said, they're easy to do, they're convenient, and you can close in 3 weeks. So that's what's nice. They close pretty fast because the process is really simple. But I'm going to touch on really a big caveat a little bit later that really kills a lot of deals. So you have 8 DSCR options. And so a wholesaler that we use calls them NANI, no owner, no income. And basically you could do a standard loan. You could do the NANI plus, which just means that you have really good credit. Foreign national, so if you don't have if you're not a US citizen, they have programs for that. They have also DSCR programs if the ratio is under 1 to 1. So if the rental income does not cover the mortgage payment, you can still qualify. You have a blanket DSCR loan option, as you can see here, covering 3 to 25 properties. Let's say you have 10, 15, 20 properties, right? And you want to do just one mortgage, that is a possibility. You also have 5 to 8 units here, or 2 to 8 unit mixed use properties. And then you can purchase them, or you could do a cash out refinance, right? So you can pull equity out of the property only using lease agreements or the appraisal report, okay? So it's really, really cool and very, very useful. Really quick bonus program that not many people know about is there are DSCR seconds. So I could put a second lien on a house that does not touch the first mortgage. So the way they work is they only use your lease agreements. It's like a cash out refinance, except you still keep the first mortgage. The rate's a little bit higher than your standard first lien because it's riskier. So you'll see 11 to 14% rate. There's no prepayment penalties on these usually. And then also one more thing too is that they're fixed rates, not variable like HELOCs. So that is the key difference, but it is an option. I'm gonna go through now the actual back end view on how lenders qualify a DSCR loan. So this is straight from their perspective with a calculator that they use. So they're going to look at the rental income. Now, how's the rental income determined, right? When the lender starts the process, they're going to have you pay for an appraisal, okay? So the appraiser is going to go out and he's going to not only assess the value, but he's also going to assess the fair market rent of the building or of the home that you're buying. He's going to take that rent, the rental income, the rental comps as we call it, and he's going to say, okay, John Smith can charge $2,000 for the single family home in monthly rent. The lender is going to take that number and say, okay, what's our mortgage payment? Does it cover? It covers, good, no problem. All right. So they're going to take that rental income with number 2 and look at the total expenses. So they want to calculate the principal, interest, taxes, insurance, and association dues if applicable. And then the ratio is calculated by dividing the property's rental income by its total expenses. And so this is a key factor. So for example, look at I have it all broken down here, and this is an actual calculator that underwriters use. And if you want a free copy, I'm actually going to put in the description and in the comments below so you can download completely free when you're looking at properties yourself. So let's say we're looking at another property for $899 here. We're putting 20% down, 7.625. Our gross rental income, and the lenders look at the gross income. So they're not going to take any like vacancy factors or any reductions, but we're going to look at $7,500 in total monthly rental income with the taxes, with the insurance. You'll see that the DSC ratio is 122%, which is good. You want it above 100%, okay? The higher to the ratio, sometimes the better the rate. So in this case, it checks out. And the calculator, again, I'll put in the description. You can just plug and play and it'll do all the math for you. Now, the next thing is, why do investors use DSCR loans? Well, obviously it's flexible and it's super easy to do. They're really good for specialized or unique strategies, whether you want to do fix and flips or fix and holds. I mean, it's a good alternative. And then also it's very easy to scale. This is how investors scale to multi-million-dollar portfolios, and having a ton of properties from 50 to 100 to 150 homes is using DSCR loans. This is their ticket, okay? If they're not getting financing somewhere else, this is what they're using. And what you see is what you get. They're very simple and they're very easy to do. Now, here's what I don't like about DSCR loans. Really, it comes down to 2 things. The first thing is prepayment penalties. every single lender is going to have them because they know that with these loans, it's easy to get and they don't want to get paid off right away. Of course, like the investors want to make their money. So if you don't want any prepayment penalties, you'll have to buy it out and get a higher rate. The other thing I don't like is that it all hinges on the appraisal. Now, most real estate deals anyway hinge on the appraisal. So this is nothing new, but it really depends on the appraisal. The rental income is huge. The rental income has to come in at where it needs to come in at to cover the payment and for the loan to qualify. Now, there are solutions if the property does not have strong rental comps. Even if the loan is under that 1-to-1 ratio, it could still work. You might have to put more down. You might have a higher rate, but it still could work. So those are the two things that I don't like. And that's the costly mistake too as well. So before I even get into the takeaways, actually, what I realize that a lot of investors do is they rush into a project and they don't do their research on the rental comps. And because of that lack of research, the rental comps killed the deal. They spent money on the appraisal, they wasted time, and that is how they lost all their basically like time and effort. And so a big thing is make sure that you're looking at the rental comps in the area. Are the tenants good? Am I going to have tenants that are long-term, right? Because DSCR loans like long-term lease agreements. They don't do short-term, right? There are short-term options. That's another video. But for the most part, do your research and make sure that you'll have not only a good value of the home or the building, but good tenants with strong rental income. Last thing, and I'll wrap up, key takeaways, is that DSCR loans are backed by residential income producing properties. They don't require W-2 tax returns and all that stuff. And they look at the total property expenses, PITIA, principal, interest, taxes, insurance, and HOA, and then they have prepayment penalties. And so that's all I got for you. If you need any help or if you found value in this, be sure to check out the DSCR calculator below. You can download it for free. And also reach out to my team and I if you have any questions about DSCR loans. Be sure to subscribe too to be the first to know about any new loan programs or unique ways you can finance. Whether it be normal or unique, we do it all. So thanks for watching. My name's Ben Steff.